Okay, let's unpack this. Welcome back to Talk Tickers, the deep dive where we take corporate earnings calls and, translate all that dense Wall Street jargon into plain English.
Right, getting past the corporate speak.
Exactly. And our mission today is to deliver actionable insights for you, the retail investor, looking at Gibson Energy's Q2 2026 earnings. Ticker symbol GEI on the Toronto Stock Exchange.
A really fascinating one today.
It is, because, look, here's the hook. Imagine moving an extra 530 Olympic swimming pools of thick, heavy crude oil in a single quarter.
That's a massive amount of physical product.
Right, and doing it during this period of near-total global shipping chaos. Oh, and by the way, they did it without a single recordable safety incident for a full year.
Which in heavy infrastructure is a major, major milestone.
Totally. So Gibson just posted these record numbers, but, and there's always a but, they are simultaneously carrying this heavily elevated leverage from a massive recent pipeline acquisition.
The Chauvin deal, yeah.
Right. So with that debt load and all this geopolitical volatility, the big question for you today is this stock a safe harbor or a really risky bet? We're going to break down the executive remarks, the analyst Q&A, and the actual balance sheet to figure that out.
Yeah, and context is so important here because the midstream sector, the companies that operate the pipelines and the storage tanks rather than actually drilling for the oil.
Toll booth guys.
Exactly, the toll booths. They're typically treated as this highly predictable, almost utility-like corner of the market. You just collect the fees. But the data from this quarter really demonstrates how rapidly shifting global trade routes and these major new infrastructure projects can force these companies to operate way outside that traditional comfort zone.
Absolutely.
So to understand the risk and the reward, we really have to look past just the top line revenue and dissect the actual cash generation.
Okay, so let's start with part one, the headline numbers.
Yeah.
And we'll start with the data forward core metrics. The immediate baseline here is their consolidated adjusted EBITDA. They hit 169 million Canadian dollars.
Which is huge.
Yeah, it matches their previous all-time quarterly record.
Yeah.
And it's a $22 million jump year over year. Now, for anyone looking at infrastructure assets, EBITDA, so earnings before interest, taxes, depreciation, and amortization, that's like the gold standard metric.
Right, because these companies own these massive physical assets. We're talking steel storage tanks, underground pipelines, and those depreciate on paper over decades.
Right. Accounting rules make them deduct that value.
Exactly. So looking at earnings before that non-cash depreciation gives you a much clearer picture of the actual operating profitability of the steel currently in the ground.
Okay, but Gibson deliberately splits that operating profitability into two distinct categories.
They do, and it is essential for understanding their risk profile. So first, you have the infrastructure segment. That generated $169 million of that EBITDA, up 17 million from the second quarter of 2025.
Right.
And then you have the marketing segment, which brought in $15 million. And that nearly doubled the $8 million they did a year ago.
Wow. So a huge jump there.
Yeah. And the distinction matters. The infrastructure side, like you said earlier, it functions essentially as a toll booth. They charge a fixed fee to let oil flow through their pipes or sit in their tanks.
Nice and boring.
Right, very boring. Those contracts are typically long-term, they're insulated from the daily price of oil, and they're highly stable. But the marketing side is entirely different.
That's where they get a bit more aggressive.
Exactly. That is where Gibson takes calculated commercial risks. They're buying and selling crude oil and refined products to capture price differentials across different geographic markets or, different time frames.
Okay, so seeing both of those segments beat expectations at the same time is what pushed that consolidated number to a record. But let's get to the metric that dictates the reality for a retail investor, especially if you're holding the stock for the yield. Distributable cash flow, or DCF?
The really important one.
Right. They reported $96 million in DCF, which is a $15 million year-over-year increase. Let me run an analogy by you. Is this DCF basically the allowance the company has left over to hand out to us shareholders after paying for all the essentials?
That is exactly the right way to think about it. It takes that raw operating profit, the EBITDA, and it subtracts the unavoidable cash expenses.
So what's coming out of that?
The interest owed on their debt, the current cash income taxes, and really importantly, the maintenance capital expenditures. The money required to literally keep the existing pipeline safe and prevent the tanks from rusting.
The non-negotiables.
Right. So that remaining $96 million is the actual unencumbered cash that they can legally and sustainably distribute to you as a shareholder. or used to pay down the principal on their debt, or fund entirely new growth projects.
So a $15 million jump in that allowance is exactly what you want to see.
Right.
But the transition from the $169 million in EBITDA down to the $96 million in DCF, that reveals a bit of tension in their capital structure right now, doesn't it?
It does. It really does. CFO Riley Hicks explicitly noted on the call that the record infrastructure earnings were partially offset by higher financing costs.
The debt.
Right. The operating business is generating significantly more cash, but the capital required to achieve that growth carries a cost. They recently took on substantial debt to acquire the Chauvin Pipeline.
Right.
And the interest on that new debt, combined with, just a higher prevailing interest rate environment generally, it acted as a friction point.
So basically, operating profit was up $22 million, but the actual cash they can hand out only went up $15 million.
Exactly. It demonstrates that the leverage is a real factor here. Though I should say a $15 million increase in DCF is still a very robust indicator of dividend health.
Okay, so the numbers are flashy. But that brings us to part two. The story behind the numbers. What exactly is pumping all this extra cash through Gibson's pipes? Let's look at the infrastructure drivers. The big one is throughput. It was up by roughly 8 million barrels year over year across their network.
Which is a massive physical volume increase. And that volume increase is really rooted in two specific operational shifts. The first is just higher utilization across their legacy network. Their existing pipes and tanks simply ran at higher capacity.
More oil moving through the old system.
Right. But the second, and honestly the more structural shift, is the immediate contribution from the Chauvin Pipeline acquisition. That officially closed on May 1st of 2026.
So they bought a pipeline? And it's already contributing.
Yes. And the Chauvin acquisition is central to their strategy at the Hardisty terminal. The CEO, Curtis Philippon, framed this as adding stable, contracted cash flows.
Let's talk about Hardisty for a second, just for context. Hardisty, Alberta, is essentially the central nervous system for Canadian crude oil exports.
That's a great way to put it.
It's this massive geographical hub where nearly all the major gathering pipelines coming down from the oil sands and the conventional drilling regions, they all converge there. And from Hardisty, the oil gets routed into the major export pipelines heading south to the U.S. refineries or west to the Pacific coast. So by acquiring Chauvin, Gibson basically bought a direct, guaranteed tributary that feeds straight into their massive storage tanks at Hardisty.
Exactly. They purchased guaranteed daily traffic. A gathering pipeline like Chauvin, it doesn't just generate its own toll revenue for moving the oil. It physically forces the product into Gibson's downstream ecosystem.
Ah, captive audience.
Precisely. Once that oil hits Hardisty, it requires storage, it requires blending and batching services before it can ever be loaded onto an export pipeline. So by controlling the inbound pipe, Gibson gets to capture margin at multiple steps of the value chain.
Okay, so Chauvin secures their position at Hardisty. But there was a data point on the call that I think completely reshapes their macro outlook. And it's all about the Trans Mountain expansion, the TMX.
This is huge.
Gibson reported that they are currently handling approximately 50% of the TMX heavy crude volumes at their Edmonton terminal.
Yeah, that is a massive, massive data point. Because the activation of the TMX pipeline, it fundamentally alters the economics of Canadian energy.
How so? Like, for decades, Canadian heavy crude was structurally landlocked, right?
Completely. The existing pipeline capacity heading down to the U.S. Gulf Coast was basically always oversubscribed. And because the producers had such limited options for export, Canadian crude had to trade at this really steep discount to global benchmarks.
Like the Western Canadian Select Differential, basically a forced discount because they couldn't get it to the ocean.
Exactly. But the TMX expansion, which essentially twins the existing pipeline running from Alberta to the coast of British Columbia, it finally provides large-scale access to tidewater.
So they can finally put it on ships.
Right. It allows producers to load heavy crude onto these massive Aframax vessels at the Westridge Marine Terminal and sell directly into global markets, particularly in Asia, where heavy crude is highly sought after by complex refineries.
Okay, so capturing 50% of that heavy crude volume right at the origin point in Edmonton, that is incredible market share for Gibson. But on the call, management kept emphasizing this specific metric tied to the TMX opportunity, the 4-to-1 ratio.
Yes.
They said historically, every new barrel of pipeline exit capacity requires roughly 4 barrels of physical storage capacity. Now, I pushed back on this when I read it because that ratio just seems intuitively high.
It does sound high.
Right. Like if a pipeline moves 1 million barrels a day, A 1-to-1 ratio would mean you need 1 million barrels of storage. But needing 4 million barrels of tank space, it's like building a massive new highway, and suddenly you need 4 times as many parking garages just to handle the traffic. Is Gibson basically just building the parking garages for Canada's oil?
That parking garage analogy is spot on, and the logistics of pipeline transport dictate that 4-to-1 necessity. It really comes down to 3 operational realities: batching, blending, and marine loading.
Okay, break those down. Batching first.
So a pipeline is not just a dedicated hose for one specific type of product. Different companies produce different grades of crude. You have heavy bitumen, light sweet crude, synthetic crude.
You can't just throw them all in a blender together.
Exactly. You cannot indiscriminately mix them in the pipe without destroying their distinct market values. So the pipeline operator groups similar grades into discrete batches that travel down the line sequentially.
Okay.
But to accumulate enough of a specific grade to form an efficient pipeline-sized batch, a midstream company like Gibson needs massive storage tanks to hold the oil for several days as it slowly trickles in from all the different producers.
So the parking garage holds them until there's enough of one type to send down the highway.
Right. That's batching. Now, blending is particularly relevant for Canadian heavy oil. The raw bitumen extracted from the oil sands, it is incredibly viscous. It literally has the consistency of cold molasses.
Well, it can't just flow through a pipe.
No, it physically cannot flow through a pipeline under normal pressures. It requires a diluent, typically something like a very light hydrocarbon liquid like natural gas condensate, to thin it out so it can flow.
So they have to mix it.
Exactly. This means the terminal operator needs dedicated tanks to receive and store the incoming heavy bitumen, separate tanks to store the highly volatile diluent, and then specialized mixing infrastructure to blend them to precise pipeline specifications before the batch is ever injected into the main line.
Wow, okay, so that's even more tanks needed. What about the third factor, marine loading?
Marine loading is specific to the TMX route. Remember, the pipeline terminates at a port in British Columbia where the oil is loaded onto ocean-going tankers. And the economics of maritime shipping revolve entirely around demurrage.
Demurrage, meaning penalties, right?
Massive daily financial penalties incurred if a ship is forced to sit and wait at the dock. A vessel simply cannot wait for oil to slowly arrive via pipeline.
It costs too much.
Right. The entire cargo must be ready and waiting in storage tanks at the port the exact moment the ship docks. Because the pipeline flow rate is so much slower than the loading rate of a tanker, you need massive storage buffers at both the origin in Edmonton and the destination in Burnaby.
I see.
So when management cites that 4-to-1 ratio while handling 50% of the TMX volume, they are outlining a structural, unavoidable demand for their physical assets. As long as the TMX pipeline is operational, the producers using it literally have no choice but to contract Gibson's tank space.
Okay, that makes so much sense now. So the infrastructure side is just riding this massive structural macro tailwind. But let's switch gears to the marketing side, because they absolutely crushed it this quarter.
They really did.
Their adjusted EBITDA jumped from $8 million to $15 million, and CFO Riley Hicks attributed this directly to strong crack spreads. Now, I want to define this without the jargon, because crack spread gets thrown around on financial TV all the time.
Yeah, it's one of those terms people pretend to understand.
Right. Can you just explain it simply? Is it basically like a baker's margin between the cost of raw flour and the price of a baked cake?
That is a perfect way to visualize it. If you view raw crude oil as the raw commodity, like flour or raw timber, then the refined products, things like gasoline, diesel, jet fuel, those are the finished cake or the finished furniture.
Okay.
A refinery purchases the crude at a specific market price, processes it, and sells the refined products. The difference between the cost of the crude input and the revenue from the refined output is the margin.
So why do they call it a crack spread?
The industry calls it the crack spread because the refining process involves using intense heat and pressure to physically crack large, complex hydrocarbon molecules into lighter, more valuable products. So when you hear that crack spreads are strong, it just indicates that the market price for the finished products is exceptionally high right now relative to the cost of the raw crude, which leads to really high profitability for anyone producing or trading those refined goods.
Okay, but Gibson isn't like a massive global refining major.
No, but they do operate a facility in Moose Jaw, Saskatchewan, and during their 2025 turnaround...
The turnaround is when they take the facility offline for maintenance.
Exactly. Deep maintenance and upgrades. Well, during that time, they invested significant capital to expand their refined products capabilities. They essentially re-engineered the facility to alter their product yield.
Which means what, practically?
It gave them the optionality to produce a completely different mix of refined outputs. And that capital investment directly enabled this Q2 financial outperformance.
How so?
Well, CEO Curtis Philippon noted during the Q&A that they witnessed outstanding margins on distillate sales products like diesel, but simultaneously they saw weaker than expected demand for asphalt.
Oh, I see.
Because they had just completed those engineering upgrades in 2025, their commercial team possessed the physical flexibility to pivot. They could shift their processing to maximize diesel production to capture those strong crack spreads while minimizing their asphalt output.
Wow, so they could just react in real time.
Exactly. Hicks emphasized that inducements in their technology systems allowed their trading desks to identify those pricing anomalies faster and execute the physical changes basically in real time.
So the marketing beat wasn't just them getting lucky holding inventory while prices went up, it was active execution. But that agility really shines when we look at the geopolitics and their U.S. gateway terminal in South Texas.
Yeah, the macro environment there has been chaotic.
Chaotic is an understatement. So despite all this global trade flow disruption and constrained vessels, Gibson actually managed to add 5 new customers at Gateway this quarter, including some super majors.
Which is incredible.
Right. So Philippon pointed to geopolitical uncertainty, elevated freight rates, and shifting trade flows. Let's break down the mechanics of why that disruption is happening. It's tied to the Red Sea and the Suez Canal, right?
Yes. With the ongoing security threats in the Bab el-Mandeb Strait, major shipping companies are routing their tankers all the way around the Cape of Good Hope at the southern tip of Africa.
That's a massive detour.
It adds roughly 14 to 15 days each way to a voyage between Asia and Europe or the Americas. And when ships are spending an extra month just sitting on the water, it effectively removes massive amounts of vessel capacity from the global market.
Right, because the ships are tied up longer, so there are fewer ships available to lease.
Exactly. That scarcity causes the cost to lease a tanker, the freight rate, to spike dramatically. So if you are an oil producer in Texas planning to export a cargo and your chartered vessel is suddenly delayed by 3 weeks or the freight rate doubles overnight, your entire logistics chain breaks down.
You literally have oil flowing out of the ground with nowhere to put it.
Exactly. It creates a massive bottleneck at the export terminals. Initially, Gibson noted this chaos caused a softer first quarter at Gateway, but the Q2 results show how they adapted. Instead of just suffering through delayed schedules, Gibson's U.S. marketing team utilized their available storage and blending capacity to provide short-term liquidity to desperate customers.
And this is where they captured those 5 new customers, including the super majors, the Exxons, Chevrons, BPs of the world. And breaking into their supply chains is famously difficult because they have their own massive infrastructure.
Right. To understand the value of this, think about it like aviation logistics.
Right.
Imagine a massive global storm grounds flights worldwide. The airlines are bleeding money, planes are totally out of position, passengers are stranded. An independent airport that suddenly steps in, offering flexible runway access, short-term parking for jets, and rapid refueling services, that airport becomes the most valuable partner in the world to those airlines.
So Gateway was the flexible airport.
Exactly. The Gateway Terminal functioned as that emergency airport for the supermajors. When their internal logistics failed because of the shipping reroutes, Gibson provided the immediate tank space to hold their crude, or they sourced the barrels they needed to fill a ship that arrived off schedule.
And Philippon said on the call that providing this emergency liquidity lets the supermajors experience the quality of the asset and the competence of the team. He said it will pay dividends in time.
It's a really calculated strategy. You convert a short-term crisis intervention into long-term contracted relationships. If you prove your reliability when the supply chain is fracturing, you're at the top of the list when they sign 10-year export contracts.
Brilliant. Now, one last thing on the story behind the numbers before we move to guidance. Cost cutting. General and administrative expenses, the G&A, came in at $16 million.
Which was a beat.
Yeah, guidance was 17 to 18 million. Hicks attributed it to organizational restructuring. And from an investor standpoint, when revenue is hitting record highs, it's so common to see corporate discipline just totally slip.
Oh, absolutely. Expenses usually bloat.
Right. So seeing them actively compress G&A while expanding the top line, it shows a really tight operational focus.
Very tight. But, historical performance is great, but the valuation of the equity relies entirely on what management is promising for the future.
Let's talk about the future then. Part 3, management guidance. Starting with the marketing outlook. At Investor Day, they gave a full-year guidance range of $0 to $40 million. Zero is obviously a very conservative floor.
Very conservative, acknowledging that if crack spreads collapse, they might make nothing.
Right, but based on the $18 million generated year-to-date, they updated that, saying they are trending toward the upper end of that $0 to $40 million range.
Which is a positive signal. But Hicks did introduce a necessary caution, specifically about Q4. The refined products market is very seasonal, like asphalt demand drops precipitously in the winter because road construction stops. But beyond seasonality, there is a broader crude market structure issue that poses a real headwind for their storage business. And it's the fact that the market is currently in a state of backwardation.
Okay, this was a massive focal point in the analyst Q&A. Robert Catelier from CIBC really pressed them on this, backwardation. Let's explain this. It's a structural condition in the futures market, right?
Yes. It means the spot price, the price of physical oil delivered today, is higher than the price of a futures contract for oil delivered in, say, 6 months.
Okay, so if the spot price is $80 today, but the 6-month futures contract is trading at $75, the market is backwardated.
Exactly. And the financial mechanics of that severely disincentivize physical storage.
Why?
Well, if you are a trader and you know oil is worth more today than it will be in the future, you have every financial incentive to sell your barrels immediately. If you choose to lease a storage tank from Gibson and hold that oil for 6 months, you suffer a dual penalty.
You pay the rent for the tank, obviously.
You pay Gibson the monthly leasing fees, yes. And then you eventually sell your oil into a market where the price is contractually guaranteed to be lower. In a backwardated market, physical storage is a guaranteed financial loss for the trader.
Ouch. So Catelier challenged management on this, basically asking if this creates air pockets, like periods where demand for tank space suddenly vanishes, and Gibson has to slash lease rates just to keep the tanks full. Because economically, nobody wants to store oil right now.
And Philippon didn't deny it. He acknowledged that North American storage levels are essentially at tank bottoms, meaning everyone is selling immediately.
But his defense was interesting.
It was. His defense relied on physical realities overriding the financial incentives. He argued that the sheer volume of Canadian production growth, plus the operational requirements of the new TMX pipeline we discussed, it creates unavoidable physical friction.
Like the batching and blending we talked about earlier.
Exactly. Even if a producer wants to sell immediately, they still have to navigate the batching, the diluent blending, the marine loading delays. They require short-term operational tank space just to keep their supply chain moving. So Philippon asserted that this structural necessity is keeping Gibson's storage assets in high demand, despite the hostile futures curve.
Wow. So it's a profound test of their asset quality. If they keep making money on storage when the market is actively penalizing storage, it proves these tanks are mission critical, not just trading tools.
Absolutely.
Okay, let's look at actionable timelines for future growth projects. They gave us 3. First, Chauvin expansion. They're planning to increase capacity by 50% from 30,000 to 45,000 barrels per day.
And they expect a final investment decision, the formal board approval, to start building by the end of 2026.
Second is the Hardisty Connection Project, tying the new Chauvin pipe directly into their core Hardisty facilities. Management says this is on track for the first half of 2027.
Which converts Chauvin from a standalone asset into a fully integrated piece of their monopoly there.
Exactly. And third, the wing-to-gateway integration in the U.S., getting Kearney and crude down to the export terminal. That's coming into service by the end of Q3 2026, so near-term cash flow.
Right.
But here's where it gets really interesting, or maybe a little scary for an investor. The elephant in the room.
The leverage.
Yes, the leverage and the dividends. So they funded the Chauvin acquisition with debt and equity. Their reported net debt to adjusted EBITDA ratio is sitting at 4.2 times.
Which is high.
And their dividend payout ratio is 88%. A leverage ratio above 4, and a payout ratio nearing 90%. I mean, that leaves almost zero margin for operational error, right? If crack spreads collapse, that debt becomes oppressive. Are they stretched too thin?
The 4.2 times leverage ratio is definitely the figure that triggers automated risk alerts. It warrants intense scrutiny. But you have to play the voice of reason here and look at the specific accounting mechanics creating that number.
Okay, play the voice of reason. Walk me through the math.
The 4.2 metric is calculated using their trailing 12-month adjusted EBITDA, but the Chauvin acquisition closed on May 1st.
Right.
So the total principal of the debt used to buy the asset is sitting on the balance sheet at the end of Q2. But the trailing EBITDA figure only includes 2 months of the cash flow generated by Chauvin.
I see.
It mathematically misrepresents the true cash-generating power of the current asset base against the full debt load.
Okay, so that's why management kept pointing to their pro forma leverage.
Exactly.
Pro forma meaning they project what the financials would look like if they had owned Chauvin for a full 12 months. And under that calculation, leverage drops to 3.9 times. But wait, let me push back here. Pro forma is an accounting exercise.
It is.
It assumes perfectly stable historical performance. But creditors don't get paid with pro forma cash, they get paid with actual cash on hand. If the market turns next month, that 4.2 real leverage is the burden they carry, right?
That is a completely valid structural critique. The risk of the 4.2 ratio is real today. But management's defense isn't just the pro forma math, it's the contractual nature of the new cash flows. Chauvin is backed by long-term fixed-fee agreements.
The toll booths.
Right. The pathway to deleveraging doesn't require Gibson to find new customers or hope for higher oil prices. It just requires time to pass so the contracted tolls can be collected and applied to the balance sheet.
So they just need the clock to tick.
Basically. And management guided a return to their target 3.0 to 3.5 times range by early 2027 just through collecting these contracted cash flows and finishing those near-term growth projects.
Okay, but what about the dividend? 88% payout ratio. Even if the debt drops, paying out 88 cents of every dollar restricts their ability to grow or survive a downturn.
Right. But again, look at the underlying data. That 88% is a consolidated ratio, blending the stable infrastructure cash with the volatile marketing cash.
Okay.
Gibson's corporate policy dictates that the dividend should be fully funded solely by the predictable cash flows of the infrastructure segment. If we isolate the data, the payout ratio based strictly on the infrastructure segment for Q2 was 83%.
Oh, interesting.
Which is well below their internal ceiling of 100% for that segment. The core toll booth operations are comfortably covering the payout.
So why is the consolidated ratio up at 88% in the first place?
It lies in the financing mechanics of the Chauvin deal. They didn't just issue debt, they issued new shares of common stock to raise capital.
Ah, more shares outstanding.
Exactly. By increasing the total number of outstanding shares, they increase the total aggregate dollar amount required to pay the dividend each quarter. It creates a temporary timing mismatch. The higher dividend obligation is immediate, but they haven't received a full year of the Chauvin cash flows to offset it yet.
That makes total sense. As those revenues roll in, the ratio will compress. And to secure the balance sheet against shocks, they just extended their $1 billion credit facility out to 2031, right?
Yes, and issued $400 million in senior unsecured notes. In this environment, getting that done is a definitive statement from institutional debt markets that they view the 4.2 leverage as temporary, not a structural crisis. Plus, management committed to $10 million in sustainable annualized cost savings starting in 2027.
All right, so that brings us to part 4, the bottom line. Let's synthesize this. What is the definitive conclusion for the retail investor? I'll put my cards on the table. My opinionated verdict is bullish.
I agree. Strongly bullish.
If you hold GEI, here's your actionable takeaway. You are holding a company that is successfully monopolizing the downstream infrastructure of the massive new TMX pipeline.
They own the choke point.
Exactly. They are integrating Chauvin flawlessly. The dividend is well covered by core infrastructure cash, and the marketing team is agile enough to turn a geopolitical crisis in the Red Sea into emergency liquidity profits in Texas.
Yes, the debt is slightly elevated, but the pathway to deleveraging by 2027 is clear and highly credible. It is a strong hold or a buy for investors seeking stable yield backed by hard assets in a crazy volatile energy market.
Beautifully summarized. Well, that wraps up this rapid-fire breakdown. Thank you all for joining us on Talk Tickers. But before we go, I know you want to leave the listener with one final provocative thought to mull over regarding the macro environment.
Yeah, I do. Think back to that 4-to-1 storage ratio we talked about. Every new barrel of pipeline requires 4 barrels of physical tank space for batching and loading. As global energy demands shift and more countries rush to build their own pipelines to achieve energy independence outside of these vulnerable maritime routes.
Ask yourself, Who else out there is quietly buying up the land to build the parking garages for all that new oil?
Because whoever controls the storage controls the market's breathing room.
Wow. Something to think about. Thanks for listening, everyone. We'll catch you next time.